Muy buenas tardes a todos. Abrimos la segunda parte de la jornada y, en primer lugar, permitirme agradecer, como no puede ser menos, la oportunidad que se me brinda de estar hoy aquí con vosotros. Creo que todas las intervenciones están siendo realmente inspiradoras, y como mi rol en este caso es moderar el coloquio que continúa abordando sobre los temas de la innovación. Mi nombre es Rosa María Di Capo, pertenezco a Mercer, lidero un equipo de personas y expertos en proporcionar soluciones en temas de compensación, jubilación y desvinculaciones del mundo de las empresas. En primer lugar, Lukas Junker intervendrá. Lukas is Head of Product Innovation, Global Life at Insurance, Zurich Insurance Group. In his role, he is responsible for driving product innovation globally, with a focus both on accumulation and retirement products. Prior to that, Lukas was partner at McKinsey & Company, where he led the German life insurance practice. Lukas holds a doctorate in business administration from RWTH Haken, I don't know if it's good pronunciation, an MBA from Macomb School of Business, University of Texas at Austin, and a master from WHU Otto Beisheim School of Management, and a CFA Charterhold. Your turn, Lukas. Thank you.
Thank you very much for the introduction. So I have the special honor to have the session after lunch. I hope you've enjoyed the lunch and I can wake you up a bit. What I will be talking about in my session is on the effect of low interest rates on product innovation. As you know, Zurich Insurance Group is present in Switzerland and in Germany. So we have actually been facing an environment of low interest rates now for many years in Switzerland and already some years in Germany. And I would like to show you a few examples on implications on the product offering and what can be done in especially savings and investment products in such an environment. So I will start with a bit of general context, then go into detail on the product offering, and then finally have an outlook of what the future could bring. So in terms of the context, this is the interest rate environment, and we can see there are 3 countries in the world that have been most affected by low interest rates. This is Japan, obviously, Germany and Switzerland. We have a situation now in Switzerland that the central bank reference rate is minus 0.7%. And government bond rates are below 0 or at 0 for durations under 20 years. So it is the dreadful 0 interest rate environment. Still, we are not just sitting in the closet and crying. We have a business that we need to run, and there is actually a way to have life insurance products be offered successfully even under such a difficult environment. Now, the effect of low interest rates, it's 3 effects. First of all, it's pressure on new business volumes. What we have seen in Japan and other countries, when interest rates go down, the savings rate decrease. People just save less. And also what customers do is they save differently. So they are less willing to save long term, which is a bit rational. So why would you lock in the interest rates of today in a 20-year product? But they shift towards short-term savings vehicles, so just leave the money on the bank account and wait and see, because tomorrow the environment could be better, and they go into real estate. Now, what does that bring for life insurers? It brings a challenge to the value proposition, because what we want to do is we want to have guaranteed products, and these guaranteed products return less if you take off the costs to the customer than they paid in, which is difficult, because then you could say, okay, let's do unit-linked products, but customers still want guarantees. So how do we square actually the circle of providing customers with guarantees, but also giving them something that has a return? And then finally, there is a squeeze to enforce economics. So we need to reinvest our assets at lower rates. Spreads are compressed and compressed, and that challenges profitability as well as financial stability. And some people have said this is a very brutal picture. It's like a train running into the wall, so we already see when spreads will go to 0, but the doors are closed and nobody can actually go out. So that's the environment. Now, what have insurance companies done globally? Actually, there are two different camps. So the first, and it's not to say the one is right and the other is wrong. It's just what we've seen on the market. So the first one is on the incremental optimization. So the market perspective here is, we as life insurers, we need to offer long-term guarantees. It's a fundamental part of the value proposition. And low interest rates are a temporary phenomenon. So, I mean, interest rates have been going up and down in the past, and for sure interest rates will go up again. So therefore, this is a temporary environment, and we will get through that. Of course, we cannot sit still. We need to do something. We need to optimize our costs. We need to reduce capital intensity of the guaranteed products. We need to optimize distribution, but in the end, we will not fundamentally change strategy. We will continue to offer guarantees, and 5 years down the road, we are confident that the environment will look better. The other camp is a fundamental strategic shift. That basically says insurance companies are not rewarded for taking investment risk. Long-dated guarantees, they are unmanageable. We shouldn't be doing that. And therefore, we want to move away from products with interest rate risk totally. We want to focus our new business on protection and unit-linked products. And in order to generate some investment management margin, we want to build asset management capabilities so we can do that in-house. And this is what most of the UK insurance groups and most of the Nordic insurance groups have done. There are no guaranteed products left in the UK, basically. And some of the UK players, like Standard Life or Legal & General, have built quite large asset management divisions. Now, at Zurich, we fall a bit more into the second camp. So if we look at our product mix, this is the first quarter 2015 numbers. 77% of our products are actually products with limited interest rate sensitivity. Our biggest part of new business is protection, and after that comes unit-linked, and our total exposure to traditional products is only 23%. So we've actually started quite early to leave traditional products. On the other hand, that brings challenges, because what do you do in unit-linked products? What's actually your role as an insurance provider? I mean, if you just deliver the wrapper and somebody else delivers the fund, and then another party delivers distribution, your contribution to the value chain actually becomes quite limited. So there is margin pressure. There's also margin pressure on protection, because if everyone wants to grow in protection over time, that will bring margins down. We are among the large insurance groups, the one with the lowest exposure to investment result. When we present this chart to analysts, I hope there are no analysts now in the room, we say this is great because we have this very limited interest rate sensitivity. Look at us. Just 9% of our operating profit in 2014 is due to the investment results, so anything can happen. On the other hand, you could see it differently, and I say that because there are no analysts in the room today. Compared to some others, we miss 1 or 2 billion of profits that we could make if we had more investment results. So you can actually see that both ways, and I think it's important to take a balanced view here. Now, with this context, what is actually the evolution of the product offering in the countries affected by low rates? And I'm going to give detailed examples for Germany and for Switzerland. Now, this is, I promise, the most complex picture you will see in the presentation. Let me try to actually explain it. So what we have here is we have different types of products, and we have classified them along 2 axes. So the first axis, the vertical axis, is the level of market exposure versus guarantees. So at the bottom of the page are the guaranteed products. Now the second axis, the horizontal axis, is the degree of complexity. So the products to the right become more and more complex. And then you have the little flags around the product, which basically say in which country do we offer which product. Now, if we go to the left of the chart, you see, let's say, the products that everybody knows. So top left, the pure unit-linked product exists in every country, is offered by everyone basically in every country. Bottom left, the opposite, the traditional savings product with a guaranteed interest rate, also offered by everyone in every country. Now, there are two trends that we observe and that we're working on, two directions. So the first direction is actually coming from the top, saying that, okay, how can we make the pure unit-linked product more attractive to customers that want some exposure to capital markets, they want some exposure to equities, but they are not comfortable actually taking the full risk, which is in most European countries still the majority of the customers. So how can we add some guarantees to increase the appeal to broader customer groups? Or it might not have to be guarantees, but some soft protection level at least. So that's the first direction. The second direction, coming from the bottom, is how can we make the traditional product a bit more bearable, reducing the capital intensity so that it's actually still possible to offer them in the current environment. So most of the action is in the middle. So what we see here is, and I'm just going to pick, let's say, some. We see hybrids of unit-linked and traditional. They also exist in Spain. So you basically say 50% of the customer's money goes into a traditional product and 50% goes into a unit-linked. Very simple. And then you can make that, of course, tailored to the customer. It doesn't have to be 50-50. It can be 75-25 or 25-75. And the customer can choose on the unit-linked part the funds that the customer wants. So that's one which is still relatively simple. Then moving, let's say, more to the right, there are more complex things. So there are, at the bottom, the new traditional with index participation. That's, I'm going to explain in more detail a bit later, it's basically a traditional product with a guarantee of 0 and an upside linked to some stock index, which is manufactured through derivatives. Or at the top, it's protected unit-linked products with an index participation. So of course we can do unit-linked products that say there is an 80% floor, you can never lose more than 20% of what you put in. And then in the middle, there's the CPPI product, or the individual CPPI product, which is a dynamic strategy that is shifting between a so-called performance asset with equity exposure and a protected asset, which is typically a money market fund, also creating a floor in the performance. Now, two additional things I would like to point out. So first of all, you see that there are two products on the right-hand side, the variable annuity and the dynamic hybrid. There are no flags in it. So we believe that those complex products are not necessarily, that's our experience, what really works with distribution. So we are, for example, we stay out on purpose on variable annuities because in our experience, it's felt a big challenge actually to make it work. And then second thing I'd like to point out, I mean, if we look at the different flags and what could be actually the kind of the next frontier for Spain, it would be those in the middle. So the protected unit linked as well as the new traditional with index participation. Now, let me go into a practical example. That's the German market. Now, the German market has seen actually a lot of innovation in the last 5 years. Not because Germans are terribly innovative, because they're not, but because interest rates have just been already quite low for a long time, and therefore the industry has been really under pressure to move. On the other hand, what is difficult in the German market, Germans are, I don't want to have too many national stereotypes, but in generally conservative. So Germany is not a unit-linked market. Germans want a guarantee. 75% of customers, that's what market research shows, still want a guarantee. Even if it's a low guarantee, that's the customer need. So the challenge is how to bring a product to the market that has a guarantee but that works in the current interest rate environment. And the types of products we've seen, it's some of them we've seen also on the previous page. It's these traditionals with index linkage. It's hybrids. Germany is the market for hybrids. So there are hybrids with, let's say, 2 different baskets, hybrids with 3 different baskets, hybrids that are static, hybrids that are dynamic. It is essentially always a combination of a traditional component and a unit-linked component that are in the dynamic variants shifted around, and the static variants are just fixed. We've also seen variable annuities. They've remained a niche in the German market, and what we have concentrated on, that's our flagship product, is the unit-linked CPPI, and that's explained on the next page. So what is it? It's actually a product we do together with Deutsche Bank. So the main distribution channel is the Deutsche Bank branches. It requires, let's say, a distribution channel with some closeness to investment products. It would not be, we sell it via agents, but it's typically not a product that is very well suited to an agent channel. The way it works is it has two components. On the left-hand side, it has equity funds, and on the right-hand side, it has fixed income funds. It's a pure unit-linked product, and the product is shifted daily between the two funds according to the CPPI algorithm. CPPI algorithm stands for Constant Proportion Portfolio Insurance. So what the product does is when equity markets go well, it will allocate more to equity. When equity markets don't go well, it will allocate more to fixed income. And through that, it gives a hard floor to the customer. So the customer at the end of the duration has the guarantee to get at least their premium that they paid in back. And in this case, the guarantee is given not by us, but it's given by the bank, by DWS. What the customer can also do is every 5 years they can lock in the maximum value, and there's all kinds of protection riders like disability that they can buy. This has been successful because it's basically the message to the customer is here you have equity exposure, which is great in the current interest rate environment where, I mean, bonds, fixed income doesn't return anything, but there is a controlled risk. You never lose what you put in. So that's one of the examples for Germany. Switzerland, you could say it's even a bit worse in terms of interest rates. So that's the country with the lowest interest rates in Europe. The specific thing about Switzerland is there is a very extensive Pillar 2. So people are covered through Pillar 2. And that's why the Pillar 3 is largely discretionary. It's saved on top. And people are therefore can afford to take a bit more risk on their Pillar 3 compared to Germany. And they are therefore a bit more receptive to unit-linked products. What works best in Switzerland, I mean, is those new traditionals, which is basically traditional products with variable interest rates using certain formulas, as well as the traditionals with index linkage. So, and that's a product that we have, and I'm going to explain on the next page. So, basically, the product has a couple of different components. Most of the premium is invested into the traditional account, but with a guarantee of 0. So it's not very capital intensive. And what comes on top, so basically the investment return that is generated is invested into a leveraged certificate. So that's basically a derivative, and that derivative is leveraged because it gives 3 times the participation in the Swiss equity market index. And the value proposition to the customer is, so you have the guarantee, right? What's invested into the traditional, it can never go down, so it's still a quite safe product. But on the other hand, you participate in the Swiss equity index. And then there is a third component. There is this light blue part in the middle. If the certificate has gone extremely well and customers want to lock in their gains, they can actually have a part in a unit-linked fund. So it's in fact a product with 3 components. Now, these were a couple of examples. So I mean, those products they appear complex, and I think the challenge is actually how to market them to customers, how to market them to distribution, so that people actually get it and are not overwhelmed by that complexity. But in the end, that's I think the direction that the market will be taking. Even conservative traditional customers will need to accept to take some equity risk in order to have some return. Now, what could the future bring? We don't know. I see 3 possible scenarios for the future. So the first one is that's like the Japan scenario. Interest rates stay low forever. Second one is the gradual rate increase. Interest rates recover, but in an orderly, slow way. And then the third scenario is a sudden rate increase, so rates jump. Now, I will not give probabilities for those scenarios because I truly don't know. I know which one I'd like best. That's the one in the middle. Probably most people in the room would like to see that one in the middle. If we have the one on top, basically, I mean, if interest rates are too low at some point, only unit link will work and short durations. So that would be the optimal strategy. If we fear the scenario at the bottom, the sudden rate increase, we need to take action to protect the in-force book because it could lead to substantial lapses on the in-force book. And the one in the middle, actually under this scenario, what would work well is having products with some flexibility so that we can make the story to the customer. I mean, whatever happens, you will profit from rising interest rates, and the returns of the products that you've bought will actually go up with rising interest rates. Now, given that the optimal actions under all those scenarios are a bit different, there's of course the question, so what could we actually do? Because I mean, you cannot do, let's say, the first and the second and the third at the same time. Essentially, the strategy that we are following is a diversified strategy, right? I will not go into every, let's say, slice of the chart, but the message here is to say, look, different products work under different capital market conditions, and therefore, if we want to be prepared for any scenario that can happen, what we need is a diversified portfolio of different product concepts, ranging from the traditional at the top to different hybrids in the middle, to short-term products and traditional products at the bottom. And then what we need is the capability to actually have a short time to market and steer the distribution in the right way so that they change the priorities according to what happens in the market. So I'm at the end. Thank you very much. I hope you could take away some ideas. Thank you.
Congratulations, Lucas, because I think nobody was sleeping. So congrats.